HOOK. Swiss banks manage over $2.3 trillion in offshore assets. Legally. But here's the ugly truth you're not supposed to know. Hook_end. Pattern_interrupt. You've heard the whispers, the myths, the conspiracy theories. But the reality is far more boring. And far more dangerous. Swiss banks don't hide money under mattresses. They exploit legal loopholes that have been carefully engineered over centuries. And if you think this doesn't affect you, think again. Every dollar hidden offshore is a dollar that could have built a school, funded healthcare, or lowered your taxes. Pattern_interrupt. Let's rewind to the beginning. Switzerland's banking secrecy wasn't always about hiding wealth. It started in 1713. When the Geneva City Council passed a law requiring bankers to keep client records confidential. The logic was simple. In a fragmented Europe of warring kingdoms, privacy protected clients from political persecution, religious discrimination, and outright theft by monarchs. CLIFFHANGER. But that noble origin story changed in 1934. When Hitler's Germany demanded Swiss banks reveal the accounts of Jewish depositors. Switzerland refused, enshrining bank secrecy as a criminal offense for bankers who broke it. Suddenly, secrecy became a shield against tyranny and a magnet for wealth. Pattern_interrupt. Fast forward to today. That $2.3 trillion figure comes from the Bank for International Settlements. And it's likely an undercount. But here's the twist. Most of that money is perfectly legal. A German dentist who opens a Swiss account to diversify currency risk isn't a criminal. A French entrepreneur who uses a Swiss trust to protect assets from frivolous lawsuits isn't evading taxes. The problem is that the same system that protects legitimate privacy also enables illegal tax evasion, money laundering, and corruption. Pattern_interrupt. To understand how this works, you need to understand three legal mechanisms: numbered accounts, bearer shares, and the foundation structure. Numbered accounts are exactly what they sound like. Your identity is replaced by a code known only to a handful of senior bankers. The account itself holds no name, just a number. If a foreign government demands information, the bank can truthfully say they don't know who owns the account. Because legally, they don't. CLIFFHANGER. Bearer shares take this a step further. These are physical certificates that prove ownership of a company. Whoever holds the paper owns the company. No name, no registration, no trail. If you buy a Swiss company with bearer shares, then open a bank account in that company's name. The money is legally the company's, not yours. And since the company's ownership is anonymous, the trail goes cold. Pattern_interrupt. Then there's the foundation structure. A Swiss foundation is a legal entity that can own assets on behalf of beneficiaries. The foundation's charter names the beneficiaries. But that charter is private, not filed with any government, not subject to public scrutiny. So you can transfer wealth to a foundation. Name yourself as a discretionary beneficiary. And the money is legally the foundation's. You don't own it. You just benefit from it. And if you never withdraw the money, you never pay tax on it. Pattern_interrupt. Now, you might be thinking, but isn't this illegal? And that's the genius of the Swiss system. It's not illegal because Switzerland has designed its laws to make it legal. The Swiss government doesn't consider tax evasion a crime. Tax fraud is. But evasion is just a civil matter. So if you fail to declare income to your home country, Switzerland doesn't care. They'll help you hide it because In Swiss law, you haven't done anything wrong. CLIFFHANGER. This distinction is why the US government spent over a decade chasing Swiss banks. In 2009, UBS, Switzerland's largest bank, was forced to pay $780 million to settle charges that it helped US clients hide $20 billion in assets. But here's the thing. UBS wasn't breaking Swiss law. They were breaking US law. And the Swiss government fought tooth and nail to protect their secrecy. Pattern_interrupt. The turning point came in 2013. When the US and Switzerland signed a program requiring Swiss banks to either disclose US account holders or pay massive penalties. Over 100 Swiss banks participated. But even then, the system survived. Why? Because the penalties were cheaper than the profits. Imagine you're a Swiss banker. You have a client with $10 million in a secret account. You earn 1% in fees annually. $100,000. The penalty for getting caught is a one-time fine of $500,000. So you have a 5-year runway before the fine hurts. And if you get caught only 20% of the time, the expected cost is $100,000 per client. Still profitable. Pattern_interrupt. This is the economic reality of offshore wealth. The system isn't designed to catch everyone. It's designed to catch enough people to maintain the illusion of enforcement while letting the bulk of wealth flow through. The OECD estimates that between $21 trillion and $32 trillion is held in offshore accounts globally. That's more than the entire US economy. And most of it is legal. CLIFFHANGER. But here's where it gets personal. You don't need millions to benefit from this system. Imagine you're a small business owner in a high-tax country. You earn $200,000 a year. You could open a Swiss foundation, invoice your US business through it, and keep the profits offshore. The foundation pays 8.5% Swiss corporate tax, one of the lowest in Europe. You then reinvest the earnings in Swiss real estate or stocks. The money grows tax-free until you distribute it. And if you never distribute it, you never pay personal income tax. Pattern_interrupt. This is called deferral, and it's perfectly legal. The US even has a law, Subpart F, that tries to stop it. But the loopholes are endless. You can use a Swiss trust instead of a corporation. You can invest in Swiss insurance products that defer taxes indefinitely. You can use a Swiss annuity that pays you a small income while the bulk of your wealth compounds. Tax-free. Pattern_interrupt. Now, let's address the elephant in the room. The myth of absolute secrecy. Swiss bank secrecy is not what it was in the 1930s. In 2018, Switzerland began automatically exchanging financial account information with over 100 countries. Under the Common Reporting Standard. If you're a US citizen, your Swiss account is reported to the IRS. If you're a French citizen, it's reported to the French tax authority. CLIFFHANGER. But here's the loophole the Swiss love. The CRS only applies to accounts held by individuals. If you hold assets through a foundation or a trust, the reporting is much weaker. And if you use a Swiss lawyer as a nominee director, the account might be reported under the lawyer's name, not yours. The Swiss government has even created a legal framework for trusts that are effectively invisible to foreign tax authorities. Pattern_interrupt. The result is a cat and mouse game. Every time a new transparency measure is introduced, Swiss bankers invent a new structure to bypass it. When the US passed FATCA in 2010, requiring foreign banks to report U.S. accounts. Swiss banks simply stopped accepting U.S. clients. When the EU demanded automatic exchange of information, Swiss banks started offering non-reportable structures using foundations in Panama or Seychelles. Interrupt. So what's the takeaway? First, understand that the system is designed to benefit the wealthy. The cost of setting up a Swiss foundation is around $10,000. The annual maintenance is $2,000 to $5,000. That's affordable for someone with $500,000 or more. But for the average person, it's out of reach. The wealthy can legally reduce their tax burden to near zero. You can't. CLIFFHANGER. Second, don't assume tax evasion is risk-free. The US has convicted over 100 Swiss bankers and clients since 2009. One client, a New York real estate developer named Robert Durst, was sentenced to 7 years for failing to declare a Swiss account. Another, a hedge fund manager named Paul Touragi, paid $50 million in penalties. The IRS has a whistleblower program that pays up to 30% of recovered taxes. Your Swiss banker might be the one to turn you in. Interrupt. Third, the future of Swiss banking is uncertain. The Swiss government has proposed a ban on bearer shares. The EU is pushing for a central register of beneficial ownership. And the rise of cryptocurrencies and decentralized finance offers an alternative that's even harder to track. But the Swiss are adaptable. They're already marketing themselves as a hub for crypto custody and tokenized assets. Interrupt. Here's the hard truth. Swiss banks don't hide wealth. They hide the ownership of wealth. And as long as there are people who want to keep their money private, there will be bankers willing to help them. Legally, the question isn't whether the system is ethical. It's whether you're willing to play by the rules while others don't. CLIFFHANGER. If you want to protect your assets legally, the best strategy is not to hide them offshore. It's to understand the laws in your own country and use them to your advantage. Tax-advantaged retirement accounts, capital gains exemptions, and charitable trusts are all legal tools that can reduce your tax burden without breaking the law. Interrupt. But if you're tempted by the Swiss model, remember the words of the late Swiss banker and whistleblower, Rudolf Elmer. The system is designed to protect the wealthy. And the wealthy are the ones who write the laws. The real scandal isn't that Swiss banks hide wealth. It's that they do it legally. And until the laws change, they will continue to do so. Interrupt. Thanks for watching. If you enjoyed this deep dive, hit that like button. It helps the algorithm understand you want more content like this. And subscribe to stay ahead of the curve. Next week, we're breaking down how the Panama Papers actually worked, and why the aftermath was a complete failure. You won't want to miss it.